Welcome to The Explainer. Our whole goal here is to take complicated stuff like financial products and make them super simple to understand. And today we're diving into a really popular one. All right, so think about this for a second. Have you ever wished for a plan that could, protect your family and give you money back at regular intervals? Not just at the very end, but along the way? It sounds kind of like having your cake and eating it too, right? Well, today we're going to look at a plan that claims to do exactly that. Let's get into the nitty-gritty of LIC's new money-back plan and see how it actually works. So, what is this thing really? Well, at its heart, it's a mix of a savings plan and life insurance. But the real kicker, the thing that makes it stand out, is that it's built to give you money back periodically. We're talking cash in your hand while the policy is still going, not just one big payout way down the road. Okay, you're going to hear two important terms here, non-linked and participating. Let's break them down. Non-linked basically means your money isn't tied to the roller coaster of the stock market. So less stress, right? Then there's participating. This is the cool part. It means you actually get to share in LIC's profits. They give you a piece of the pie in the form of bonuses. So it's all about stable, steady growth without the market headaches. All right, so you might be thinking, this sounds interesting, but can I even get it? Let's look at who this plan is actually for and what you'd need to commit to. So, check this out. The age range is pretty wide. Anyone from 13 all the way up to 45 can get in on this. But here's the part I find really interesting. The policy itself runs for 25 years, but you only have to pay premiums for the first 20. That means for the last 5 years, you're not paying a single rupee, but you're still covered. That's a pretty sweet deal. Okay, now we get to the main event, the part that gives the plan its name, the money back feature. This is where you get paid back parts of your investment during the plan, not just at the end. It's officially called a survival benefit, which basically means you get paid for, well, surviving. So, how does this work on a timeline? It's really straightforward. The plan is set up to give you these payouts at 4 key moments, at year 5, year 10, year 15, and year 20. And then, of course, you get the big final payout at the 25-year mark. But the big question is, how much are we talking about at each of those stops? And here's the magic number, 15%. That's it. At each of those 4 points we just talked about, year 5, 10, 15, and 20, you get 15% of your total sum assured back in your pocket. This is a game changer because it gives you cash flow when you might need it most. Think about it. That could be for your kids' college fees, a down payment on a car, or just a nice little financial boost right when you need it. Okay, we've talked about the money you get back along the way, but what happens at the end of the road? There are really 2 major outcomes for this policy, and it all depends on what happens over those 25 years. So it really boils down to 2 scenarios. The death benefit, which goes to your nominee if the worst happens, and the maturity benefit, which you get if you see the policy through for the full 25 years. Let's take a look at what each of those payouts actually includes. All right, let's talk about the death benefit first. If the policyholder passes away, their nominee gets a really comprehensive payout. It's not just one number. It's calculated as the higher of 2 things, either 125% of the basic sum assured or 7 times the annual premium. And on top of that, all those bonuses that have built up over the years get added in. Plus, and this is a big guarantee, the total payout will never be less than 105% of all the premiums paid. It's a solid safety net for sure. And now for the much happier scenario. If you complete the full 25-year term, you get the maturity benefit. And here's how that works. You get the remaining 40% of your sum assured. Now remember, you already got 60% paid out to you in those 4 15% chunks, so this is the rest. But that's not all. You also get all of the bonuses that have been adding up over the years. This is like the grand finale, your big reward for sticking with it. But wait, there's more. This plan isn't just a rigid take-it-or-leave-it kind of deal. There are actually ways you can customize it to better fit your needs, from adding extra coverage to choosing how you want to get paid in the end. So, let's talk about riders. The easiest way to think about them is like add-ons or optional extras when you buy a car. For a little bit more in your premium, you can add extra layers of protection. For example, the accidental death and disability rider. If something happens due to an accident, this rider kicks in and provides an additional payout. It's a way to bulk up your safety net for specific risks.
Now this is a really powerful option. It's called the settlement option. Instead of getting your final payout as one massive lump sum, you or your nominee can choose to receive it as a regular, steady income over 5, 10, or even 15 years. Just imagine, for a nominee, this could be so much more manageable than a huge check. It turns the benefit into reliable monthly support, which is incredible for long-term financial security.
Okay, so we've gone over all the big-ticket items, the benefits, the features, the payouts. But you know, with any financial product, the devil is in the details. So let's look at some of the important fine print. It's easy to get focused on the big numbers, but honestly, it's the day-to-day practical stuff that can make or break your experience with a policy. So let's quickly cover 3 super important conditions that you'll want to remember. These 3 things right here offer some amazing flexibility. First, the loan facility. If you need cash in a pinch, you can actually take a loan out against your policy. Super useful. Second, the grace period. We all get busy, right? Well, you get a 30-day buffer to pay your premium after the due date before anything happens. And finally, this one is huge, the revival period. If life throws you a curveball and your policy lapses, you have a 5-year window to get it back on track. That's an incredible safety net to protect your investment.
So at the end of the day, when you put it all together, the regular cash payouts, the guaranteed protection for your family, the steady growth away from the stock market, you have to ask yourself, does this plan fit my financial goals? It's about more than just the features on paper. The real question is whether this plan's predictable, structured journey matches up with the wonderful, unpredictable journey of your own life.